So I'm kind of pulling out some positive themes throughout the data this month, um, and because I know it's been kind of doom and gloom for quite some time, and by no means are we in some kind of boom and it's all good news and rainbows and unicorns and so on. But I am going to do my best to kind of point out some positives as we go through this. Um, and but to start with, converse to what I just said, Wellington region values are actually at their lowest point in April since the 2021 peak. Wellington City, not quite so much. The lowest point was a few months ago. Um, but Wellington region, yes. Come on. Someone else just joining. Excuse the interruptions. Um, the the message to sellers is that it's not like a strong market, but the good news is the fundamentals um, are showing evidence of having stabilized, and for buyers there is still plenty of choice. So let's look at this. Start with this, which is median sale price for a very long time now, since kind of July 2022 when things started to sort of stabilize. They hit kind of late 700s for the first time in a while. Since then, they have been broadly going sideways. It doesn't. There's a lag to the 6 month result, of course, but in the monthly results, you can see we were down there. Way back here, just over 800 for the first time. So since then, we've been going broadly sideways. That is a very long time. The big drops are way behind us now. Those days are gone. And so we still sort of hear people referring to prices dropping. Well, prices haven't really dropped by much at all for several years now. That all happened really quite precipitously in the 12 months after the peak was passed. Excuse the ongoing interruptions. I'm just continuing to let people in. So that's positive news. 765 in April versus 772, or just under a year ago. So broadly the same. So that's no change there to the overall theme, which is going sideways. Real Estate Institute's House Price Index is the best guide to underlying values. For a long time, Wellington has been the biggest negative number here. And so that kind of, on the surface of things, looks like ongoing bad news. But as per the median sale price, it's been at that level for over 3 years. So it's kind of like no change, material change has happened. So it's not getting better. Prices are not going up, but they're really not going down in any major way either. Auckland's not that far behind us, and over the last year, Auckland and Wellington are kind of there together, holding hands, and the rest of the country doesn't fare quite so bad. But even Auckland and Wellington, as the worst faring regions, if you like, are still they're very, very small numbers at 2.5% and 2.8% respectively. Over the last 3 months, there are regions which have suffered, done worse than Wellington. But if you look up and down that column there, you'll see they are all very small numbers. A bunch of them positive, some of them negative, but they're all hanging around zero, broadly speaking. This is the showing in a graphical form there. So look, you can see there was big upswings, big downswings. Then we saw quite a boost to the market as we headed into the election. And this is one thing I'm saying to some people is that it's possible we could see that again this year. Maybe. What would drive that? Possibly, there's two things. One is we're heading into winter, and a lot of sellers think winter's a bad time to sell. Therefore, the flow of new listings coming to the market dries up, and that makes selling conditions better for sellers because you're competing with fewer new listings. Still, a whole bunch of existing stock on the market, but it's the new listings which really attract the attention of the buyers. And then on top of that, again, people have this idea that selling before an election is a bad idea. The election coming up soon seems to have people hold back from some major decisions, and so they sit on their hands. And so not only have you got winter slowing new listings down, you've also got the election slowing the flow of new listings down. And that's what happened 3 years ago, and you can see the impact of that as we came into the elections here. If we see the same thing this year, that will be interesting, and it'll be nice to see some firming. Of course, hard to know, but that you saw my little sneak preview there. Values are much more stable in the last year than they have been in the 3 or 4 years before that. So you can see that's kind of like a stock price movement graph there. We were moving with huge variability, massive upswings, massive downswings. And over the last few years, it has really narrowed to this really narrow kind of trading range, if you like, small increases, small decreases over the last 12 to 15 months or so. So in my opinion, the longer this goes on for, the more confidence it will give both sides of the transaction. It will give buyers confidence that they can buy without too much risk of prices collapsing, like catching a falling knife. And similarly, as a vendor, it's nice to sell into a stable market, so you're buying and selling at similar values. And so I thought that was quite a nice little graphic there to show that things really have stabilized in terms of price movements there, or value movements. New listings. Look, you can see there for many years we were bouncing between 600 and 800 a month. Things dried up a bit as we came into COVID for obvious reasons. Then we had this considerable increase in supply, and that supply increase continued for a number of months past the technical peak. Then, when people saw that it was becoming really difficult to sell properties again, they didn't have to sell. And so the amount of new listings coming to market dried up, and it dried up horribly. And there's that real aggressive drying up of new listings as we headed into the last election and in wintertime last time round. After the election, all of a sudden, lots of properties coming to market, which made it significantly harder to sell. And then since then, again, we've been bouncing around in this quite normal range between very high 500s and late 700s. Someone else just coming in, excuse me. And so, again, you can see over the last, say, 2 years, the amount of supply coming to the market has actually been quite normal. Again, look at the data there, 623 in April versus 630 a year ago. That's almost no difference. And fewer listings by 20% compared to 2 years ago. So that is in the favor of sellers. Obviously, you want fewer listings rather than more listings to make it easier to compete for the attention of buyers. So it's definitely better in terms of new listing flow coming to market than it was 2 years ago. But over the last, compared to last April, very, very, very similar. So yeah, new listings stable versus last April, big drop versus April before. And interestingly, at 623 new listings, bang on long-term April averages at 622. So from a new supply coming to market perspective, April was absolutely typical, a normal market in terms of supply coming on. And again, you can see it this way. A stable market looks like the red line, the trend line, bouncing around the x-axis. We had stable, consistent supply volumes coming on for several years leading into, then we had drying up as we headed into COVID, then a big increase, then a big decrease, a massive increase again, then a big decrease, and then again, more recently, stabilizing. And I've drawn the old stock chart here again. So going from a lot of variability in new listings coming to market to much less variability. So again, the trend here is stability. What about number of sales? Again, similar story. So typically, again, we see often a normal market between 600 and 800 sales taking place in a month. Big drop off there as we headed into as we headed into March 2023. We saw all this new supply coming on. Then supply started slowing down as we headed into the election and winter came, and we saw sales volume start to recover. It has consistently recovered since the really low levels we saw here in 2022. These were really dark days for selling real estate, hard for the agents, hard for the vendors. They have consistently, by no means a boom, but gradual, consistent improvements in sale volumes, then a plateauing and a stabilizing at what I would term to be the low end of a normal sales range. So, not high sales volumes, but not drastically low like we saw through here in the really hard years of 2022, 2023. But we are no longer kind of clearly improving, but not deteriorating either. Very slight deterioration here in the last 6 to 8 months, ever so gradual. But the broad theme here is stable for 18 months or so. And again, bang on April norms. So not only do we have the number of new listings coming to market, absolutely typical for April, the number of sales at 620 in April this year, absolutely typical compared to the normal April sale volume 625. Compared to a year ago, 5% down. Compared to 2 years ago, 2% up. There or thereabouts. Stable market again. And this is the consistent theme. If you look at the trends here, we have been broadly stabilizing the market. And I think for sellers, my message is things don't need to be booming for the market to be functioning fine. They just need to stop deteriorating like we were seeing for some time. And I think a lot of us have still got our heads stuck in this, the market is bad. Well, no, the market has moved on from deterioration and it has been for some time now been heading towards and into and has been quite stable. And I think that's not an unhealthy market. Again, you can see that here. So lots of variability, big swings above the x-axis, below the x-axis, above the x-axis, and then more recently, a period of stability again. Slightly fewer sales than last April, 5%, but 2% more than the April before. Number of days to sell. Now, this is a data point that has been steadily increasing, which is counter to sellers' interests. And at 45 days, that is quite a long time for an April. What's typical in April is 37. So again, you look at that red line, the trend is showing that in the last couple of years it has been increasing. In the last 6 months, though, broadly flat around that late 40s, 50. And for the last couple of months, we've had 45 days, as you can see here, and it's certainly at 45 days, it's a long way off these peaks we saw here in January and February. And it's significantly down on these peaks at early 50s and way different than what we saw here, which was 50 to 60 in, again, those really tough years, 2022, first half of 2023. Things again here, significant improvement as we headed into, you guessed it, the election last time. So it'll be interesting to see, again, if this is a pattern that repeats itself this year and if we see this heading back downwards. But look, it is still taking quite a long time. It's just way off the peaks that we have seen at various points in the last 4 years or so for the last couple of months at 45 days. Inventory, again, you have seen inventory increasing over the last few years since, again, it came down and really tightened up going into the election last time. The increase was fairly marked. And then again, for about the last 18 months, it has been increasing, but very gradually, broadly sideways to moderate increases. Although, look, those last 2 months here, March and April, we have seen significant steps up. So again, we will see if that continues, and if it does, then that again, that red line, the trend line, will indeed take on a sharper gradient. Um, for some time, as you can see here, we have been operating with inventory that is bouncing around the long-term average of 15 weeks. Again, the narrative has not been this is the normal market. The narrative has been this is a tough market. It is a clear buyer's market. And this data does not suggest that. And one reason for that is that for the last 11 years, the average inventory has been under 11 weeks, and we've been bouncing around 15. So it is more inventory than we are kind of used to in recent living memory. Okay, number of trade me listings. Oh, look at that. I apologize. I've left the numbers out here, but you can see we're up a little bit compared to a year ago, and we are up sort of 15% or so, or 13, 14% on 2 years ago. Again, the shape of the graph is probably more instructive than anything. Yes, we're seeing dips and increases in dips. That is seasonal. But again, over the last 12 months, it's been ups and downs around a reasonable norm of around that 3,000 mark. So the consistent increases or the highs and the lows around an increasing trend hasn't been the case for the last year or so. And again, you can see that here in the comparison to 12 months prior. So, as with earlier graphs of this nature, big increases, significant decreases, increases again, but bouncing towards that mean reversion, heading towards that x-axis. So again, I've drawn the nice convergence graph there to again accentuate the theme, which is just coming through time after time after time in these data slides, and that is the market has stabilized. We are not seeing these massive swings in variability. This should give both sides of the transaction, buyers and sellers, confidence to transact. So in summary, values have been broadly stable for several years, albeit very small drops over the last 12 months. New listings stable and absolutely at April norms. Same with sale volumes, stable and absolutely at April norms. Inventory above long-term levels in the last 2 months, but the last year or so before that, pretty typical. Duration to sell has been long, but again, off recent peaks. So longer than what is typical for this time of the year, but significantly less than we saw in January, February, and then going back a bit further than that, we saw significantly higher peaks than we have seen in the last couple of months. Also, trade listings slightly up on a year ago, but not by much. And again, stabilizing. So as I sort of said, sellers, the fundamentals are still, they're not strong, they're weak, but they are stable. It's not getting worse. It's not getting better. We are just in a market of stability now, is my take on things. For buyers, it's still a great time, heaps of choice, so get in amongst it. So thanks as always to Real Estate Institute and realestate.co.nz. Now, I have got a bunch more general economic kind of info, which many of you may be across already, but I did this because I ran the team for the training for the team this morning. And so I'll run through this. If you want to drop off, by all means do, but I will run through this in case it's of interest. And again, I'm trying to pull out what are the positive themes, trying to look at glass half full, because there's been this real strong narrative of the Wellington real estate market is crap, and I'm trying to pull out, well, what are the good things about the market? And so one good thing, obviously, is this is an incredible opportunity for first home buyers. And I'm pleased to say they have been taking up that opportunity. Let me see, we got a question here. Let me see, is this something we need to do? Extras for experts. Yes, exactly. You get rewarded. Exactly right. What we're seeing here, this is nationwide, and the purple line here shows the percentage of sales that are going to first home buyers. So you can see clearly very consistently on the increase since way back in 2014. I don't know what was so hard about the market in 2014 for first home buyers, but it dropped down to sort of 17% of transactions going to first home buyers. 17! Well, today we're at 27 nationwide. So that's a big increase. It's the busiest segment of the market, first home buyers. So that's great news to see first home buyers getting in amongst it. This one I thought was interesting too. The red line here shows the average age of the first home buyer. Now, for a long time, basically the narrative has been it's impossible to buy your first home. These poor first home buyers, give them a break. Well, you can see here that over the last couple of years, the average age of first home buyers has been coming down. So this clearly demonstrates it has been getting easier for first home buyers. So again, that is good news. Interestingly, the average LVR has been increasing, but I don't think that is a reflection of the circumstance of the first home buyers. It's a reflection of the increasing flexibility of the banks and their increasing leniency in the LVR rules, and so on. So this is all positive. So the two main things there: more transactions going to first home buyers, great news, and the average age of first home buyers coming down, great news. People getting to their homes earlier on average. And just on the same theme, Wellington here is leading the charge. So the purple line there shows the proportion of transactions going to first home buyers in that region. So Wellington, more first home buyers, a larger proportion of the local market in Wellington going to first home buyers than anywhere else in the country, 37%. And in fact, if you dig deeper, more granular again, the Hutt Valley is 41%. So the first home buyers are going nuts in Wellington and in the Hutt Valley. Now, that is completely inconsistent with this belief that it's just so hard for first home buyers to get into property, and it is completely inconsistent with the belief that first home buyers, just can't do it, and it's too hard. So more first home buyers than any other segment of the market, and in Wellington, and that's what I was going to say. It's completely flies in the face of this notion that Wellington is expensive. First home buyers are getting in Wellington more than anywhere else in the country. That suggests Wellington is affordable, which is a good thing. So on that note, here we have the affordability metrics, and this is Cotality data. The four key metrics that they look at: the average value of property, the price of property compared to the average household income, on average the amount of household income that is consumed by the typical mortgage payment. How long does it take to save a deposit, which I believe is a 20% deposit? And how, for those households renting, how much of the household income is going towards rent? And in all these measures, the metric has retreated back to a time quite some years in the past. So 6.4 down from 8.2, and indeed the number would have gotten higher than 8.2. I think it got to something like 9 or something like that. But this was just 5 years ago. So more recently than that, it continued to climb from 8.2 after Q4 2020. It would have peaked in about Q4 2021, and I think it was over 9. So down to 6.4, massive improvement, and the numbers we haven't seen since sort of 7 or 8 years ago. Share of income going towards mortgage repayments, 37%. It was 40% 5 years ago. It would have been significantly higher than that. I don't know whether that's 42 or 44 or 45% sort of 4 years ago. So significant improvement there. How long does it take to save a deposit? 8.5 years on average versus 11 5 years ago. And again, it would have been 12 or 13 potentially 4 years ago. So 8.5, not that different to what we saw 10 years ago. So this is great news. Rent to income, and this is the one that's really changed, and that is at 22%. That is really quite affordable. Now, anyone who's on the call who's a tenant and who doesn't like paying their rent, you might, now you want to cancel me because you don't agree that rent is highly affordable. But compared to other parts of the country, this is a low number, seriously low. There are other parts in the country which have, in recent times, been as high as I believe it's 40%. So, relatively speaking, 22 is highly, highly affordable. And at 22%, it's a level of affordability that we have not seen for over 15 years. Now, this is not a number that should increase in time. It absolutely should mean revert. It should be, you know, times when it's over, times when it's under. You cannot have rents outpacing wages. That's just obviously doesn't work. Um, and so I would expect that number to on average, be a consistent number. But the fact that it's now lower than it's been for over 15 years indicates that that rent is definitely affordable in Wellington. And those of you who do have property and who have suffered rent declines and are really struggling with your cash flow, as many investors are, what this is just one little data point which shows that when pressure does come back in terms of demand, there is plenty of headroom in terms of upward movement in rents before rents become unusually unaffordable in Wellington. So anyway, affordability in Wellington has improved significantly in every of all of these four metrics, which are tracked by Cotality. So this is awesome for buyers, and look, it's positive for our society. It doesn't do our society good to have housing be completely out of reach of people. Students are back. This is a positive theme too. So student numbers are up significantly in 2025, then again in 2026. We dropped something like 15% from 2021 to 2023, and we have now broadly recovered. So that is great news. Student halls are now full again. And so what we saw since the numbers started tailing off in 2021, we had more capacity growing in the halls because, of course, what typically happens with a student is in their first year, a bunch of students will go into the halls. Not all, but a bunch will go into the halls in the first year. In the second year, they come out into the private rental market. When the student numbers going into the halls drops significantly, it creates capacity in the halls, and so the university offers for them to stay longer. So the student numbers at the universities was down 15%, but the number of students coming out of the halls was down significantly more than 15%. And that is why the student rental market in particular was totally crushed, and rents really, really got hammered in that particular segment of the market. Well, now that the university numbers are back up again, now that the halls are back full again, then the new intake of first years coming in for 2027 academic year will squeeze all of those students out of the halls, and they will be back out into the private rental market again. So my personal prediction is that we are going to see significant strengthening of, in particular, the student rental market as we enter this summer. Now I can see somebody ask a question, and I now can't access that, so I'm going to have to come back to that. This is one that I don't think many people talk about, and for a long time, Wellingtonians have been complaining about the years of construction, road cones, disruptions, closures of public assets, massive repair costs, enormous amounts of capital going into repairing these public infrastructures, if you like. Well, now a bunch of these have come online or are coming online soon. And whilst, in my personal opinion, they weren't necessarily all good value for money, they wasn't necessarily all worthy of hundreds and hundreds of millions of dollars of ratepayers' money. Nonetheless, all of that money has broadly been spent now. That money is gone. And so it's now time to start getting some payback, some return on all that enormous investment. And regardless of if that, even if that return is a really relatively low level of return, not a very good return on the investment, it is still a positive return nonetheless and better than nothing. And so this will support the city and perhaps bring some vibrancy and life and activity and money back into the CBD. So the library, Civic Square, Town Hall, City Gallery. Last weekend, of course, you probably know the bike lane from Petone into the city along the waterfront that was opened up. They're finalising the construction of the bike lane round the bays, and once that's finished, I think you basically have continuous bike lane round the waterfront from the airport to Petone, which is a cool thing to have. I mean, that's the sort of thing that people might come in and do for half a day while they're coming to visit Wellington for the weekend. It's very different, in my opinion, from some of the bike lanes in the city, whereby, I mean, my bugbear is the bike lane in Cambridge Terrace. You've got this whole lane of traffic being taken out, and the cars are queuing up, and there's no one in the bike lanes, or almost no one. But whereas this is a great asset to have for people visiting the city. So all of this years of disruption and slowdown and kind of pain, that is coming to an end now, and these assets will remain available and open and able for us to enjoy for decades and decades. And so that return, whether you believe it's a high return and whether it was worth it or not, it is a return nonetheless. And so that, I think, will bring some life and activity back to the city and the CBD. The reputational repair, I think, will also, it'll be slow, but it is a positive, not a negative. We've also got immigration rising there. So you can see, look, we're not, by no means are we booming, but is that immigration trend in the last 12 months or so, is that going in the right direction versus the wrong direction? Yes. Is it only a small increase? Yes, it is. But if it's small in absolute numbers, but if it's a small improvement off a very, very low base, it can still make quite a significant difference. So you see there, quarter one, 2026, 12,000 net bound immigration into New Zealand. And it was something like 12 or 14,000 a year or 15 months prior. So we're now getting what was a year's worth of net inbound immigration in the first quarter of this year alone. So on an annualized basis, that's 48, 49,000. So that's way, way higher than what we've seen recently. And as I say, they're up 182% versus the same period last year in 2025, and the biggest quarter for 2 years. So this is, like I say, not booming, but the trend is upwards, and it's both fewer Kiwis leaving and more permanent arrivals. So, I mean, am I suggesting we are heading towards 130, 140,000 again? No. And do we necessarily want that many? No. But I think more than what we've seen in the last 12 or 18 months will certainly be supportive of the real estate market, put it that way. Obviously, immigration impacts rental market first, and then later purchase market typically. And of course, the immigration drivers, for a long time, the Australian economy has attracted a lot of our young people over. Well, I've been noticing for some time that the Australian economy has been weakening, but that narrative is only just now, I think, starting to come through in the sort of public domain in any kind of degree. House prices over there are eye-watering still. Interest rates higher, inflation higher. It is not all amazing over there. Of course, we've also got this ridiculous geopolitical turmoil in the Northern Hemisphere generally, and rising dissatisfaction among Americans. And so all of these things, if you think, okay, are these going to be supportive of immigration? Are they going to undermine immigration? Well, it's got to be supportive. I'm not suggesting immigration is just going to go like a hockey stick because of these things, but they will definitely support more people coming in, and they will discourage Kiwis leaving. And so I think there's reason to believe that the recent turnaround in immigration and the improvement and the increase in the immigration numbers, given these drivers here, more likely to increase than decrease. And I don't know if you guys saw this article that came out from Trade Me, basically saying we've had big increases in inquiry levels from overseas buyers on the expense of real estate, the $5 million plus properties. Now, obviously, this doesn't impact Wellington an awful lot. 2 million, 3 million is an expensive house in Wellington. 5 million is almost none. Not none, but almost none. And the number of inquiries for these, ultra expensive properties in New Zealand has increased in the first 4 months of this year by 53% versus the same 4 months last year. And it's UK, Australia, and Americans are punching above their weight at 73% increase in inquiries from them. So again, this will support immigration, support the real estate market, not undermine it. And again, more points on the rental market. So here's some interesting numbers for you. So the Wellington average rents peaked in February 2023, $747 a week. In August 2025, it reached a low at 599. That is 20% down. Now, admittedly, monthly data, you do get some variability, but nonetheless, 20%. Honestly, if someone had said to me 3 years ago, 4 years ago, is it possible for average rents to decline by 20% in Wellington City? I would have said absolutely not. Well, never saying nothing's impossible, but so incredibly unlikely. And that's one of the beauties that I've always maintained about residential real estate is that if you cannot get it rented, you don't have to adjust the rent by much, and you've got your vacancy sorted. Unlike commercial property where you can have vacancy for years. Um, that's just not the same problem in residential. Well, I'm eating my words now because we have seen significant drop-offs in Wellington, as I'm sure you all know. 20% is a big drop. Well, since then, April average 620. So it's 3% up on 599. Again, is that booming? No, it is not. But has it stopped deteriorating? Yes. Is it now going in the right direction? Not right from a tenant's perspective, but right from a property owner's perspective. And again, so the answer is yes, this is slowly increasing. Um, I haven't got it here, but I also saw it was something like we have 15% fewer vacancies advertised on Trade Me in Wellington than we did this time last year. Still way above normal. Still oversupplied, but oversupplied to a lesser degree. So again, moving in the right direction, trying to pull the positives out here. The market is not getting worse. The market is turning, and I think many of those slides which I showed you before demonstrate stability or things slowly turning around. Um, we have seen, and Tony Alexander's surveys has shown that for every one investor looking to purchase residential investment property, we have three or four investors looking to sell. So what is happening to the structural long-term permanent supply? Not the number of available rentals, the number of long-term permanent rentals in the whole marketplace. That has been going down. So why have rents gone down? Well, because at the same time as structural supply coming down, we've had temporary supply going up as vendors fail to sell their houses and decide, oh, well, I'll just rent. And so these properties come to the market, to come to the rental pool temporarily. Once the sales liquidity increases again, as we have seen it doing reasonably consistently, those properties will leave the rental pool again. We've had big reductions in student numbers, like we've talked about. We've had big reductions in terms of temporary employment in Wellington. We've had 10,000 jobs, 10,000 fewer jobs than 3 years ago in Wellington. So we've had demand temporarily suppressed. Well, student numbers are back. They're about to come pouring out of the halls again. Eventually, those temporary supply in the rental pool will vacate the rental pool again, and eventually, we've got we have been a bit more stable in terms of job losses. The rate at which jobs are being lost has dropped right off. We've gone from 3% to 6% unemployment. Well, in the next 3 years, our unemployment's not doubling again, or it's not even going from 6 to 9. It might stay at 6, but even if it stays at 6, it's not getting any worse. Eventually, economic recovery will take place. People will come back. People will feel like people will get more jobs. They'll move out of Auntie Agnes's spare bedroom or in the garage and into their own place again. So demand will recover. And when it does, and that temporary extra supply exits the rental pool, it is very difficult for rental supply to respond quickly. In other words, to increase new rental supply quickly. It's very inelastic. So my personal prediction is when that happens, and is that in the next 12 months? Is it in the next 24? I don't know, but it is coming, and I don't think it's that far off. I think the rental market is going to recover before the sales market will. We will see rents go up definitely, in my opinion, before prices go up. And so rents are going to rebound strongly. We've had such a deterioration, a decline in the amount of supply that's out there. When the demand comes back, it is not going to be pretty. And I can see the headlines now. We've all been there before. So anyway, look, that's my prediction. Is it possible I'm wrong? Absolutely, it's possible I'm wrong. But you can see my logic there. So in summary, look, we are past the worst of it. The hard work's been done. The heavy lifting has been done. Prices, new listings, sales volumes, they're all stabilising. Several drivers are supporting the market, including student numbers, affordability, improving rental market. Because that's the other thing, of course, when rents do go up, that will push a whole bunch of tenants who've been thinking about it, but they can't be bothered getting around to it because there's no reason to get out now and do it when prices aren't going up. I'll just do it in a year. The immigration numbers, the labour market, the unemployment stopping rising, the public assets coming back on stream. All of these things are and will be Wellington's green shoots that will support the recovery of the property market eventually. In the meantime, I think what we've got is a market that's stable compared to the heady days of 2021, 2020, 2019, it's a lot tougher than that. But this is probably more what a normal real estate market feels like. It's not normal to have 5 or 6 or 8 offers for every property. It's more normal to have time to consider things and do your due diligence and have some haggling and some negotiation and for both the buyer and the seller to think, gee, I didn't quite get what I wanted, and gee, I paid a bit more than I wanted. This is it's not a boom market, it's not a collapsing market, it's just a middle of the road market. And I think this might be the new norm, the new normal for a period of time, whether that be another 1, 2, I think it could be another 3 years before we start to see prices shoot away. But I do think rents are going to shoot up before then. But eventually, it will all flow through to a gradual recovery. So, anyway, I hope that's been interesting, that kind of deeper dive into general economic data with a Wellington centric bent and looking at it through a lens of what does this mean for the Wellington property market. But if anyone's got any questions or want to discuss anything, then please unmute yourself and just ask away. I don't know what's going on with my mouse. It's not letting me access the comments. So if you've got comments in there, I can't see them. Oh yeah, there we go. I can now. Um, Michael, is this still Wellington or New Zealand? No, these comments I'm talking about in terms of the rental market, in terms of the prices and new listings and stuff. This is all Wellington, and all that commentary I've just been talking about is. I mean, some of it was including New Zealand data, but it was focusing on Wellington. So yeah. JT, great slides. It's important to know what's happening nationally and internationally. I feel like, yep, nationally and internationally. Yeah, I mean, internationally, yeah, it's obviously there's all sorts of things happening. I'm sure the real estate market in Dubai is pretty interesting right now. That's for sure. Any other questions or anything else you want to talk about before we sign off tonight? No, all good. All right, Hal, thanks for checking in, guys. If you do want individualized advice, then yeah, feel free to reach out. Happy to help. Thanks for checking in. Have a good night and have a good month, and see you next time. Cheers.